The average true range is one of the best indicators a day trader can use, as it basically tells you how much the price of a market moves up and down. The ATR indicator is always moving. It goes up when price movements get bigger and down when they get smaller. Every time a new time candle forms, the ATR gets a new reading. On a 1-minute chart, the ATR is figured out every single minute. On a daily chart, the ATR is calculated once a day, so the ATR differs from time frame to time frame. All these readings are connected to make a line, and this lets you see how the price swings have changed over time. The ATR has one main job: to tell you how much the price of a market is really moving around. When the range is big, it means there's a lot of volatility. When the range is small, it suggests price action is calm. The ATR is basically a special kind of moving average of the true range. Most of the time, traders use the 14-period ATR, but you can use shorter or longer ATR values, depending on the time frame you're looking at. A longer ATR will be slower and give fewer trading signals. A shorter ATR will give more trading signals and make you trade more often. Here's how to read the average true range indicator. First, the ATR is a tool for filtering trades based on how much the price is moving. If you like markets with big swings, the ATR can help you avoid markets that are too calm. If you prefer quiet markets, the ATR can help you stay away from times that are too wild for you. But it's important to remember that the ATR doesn't tell you which way the price is going. By looking at the default ATR indicator, you can't tell what the main trend is. The ATR only measures how big the range is. It's not the best for making trading signals on its own. I have a solution for this. I'll explain it in a few moments. Now the market moves in cycles. It expands and contracts, and moves from periods of rest to periods of activity. And the ATR is your key to understanding these cycles. When the ATR is low, when it's at its lowest values, it's a sign that the market is in a phase of consolidation. This is the market's rest phase. Volatility is low, and there's not a lot of action happening. This phase of consolidation is often seen in chart patterns like rectangles, triangles, or flags. The price is essentially coiling up, getting ready to move in one direction or the other. This is your signal to be on high alert. So, when you see the ATR at its lowest values, you start to prepare. You look for clues as to which direction the market might break. You look at things like the overall trend, key supply and demand areas, volume or candlestick formations. You use these to get a sense of the market's intentions. If the prevailing trend is up and the price is consolidating above a key demand area with a low ATR, you might anticipate a bullish breakout. The market is catching its breath before the next leg up. On the other hand, if the prevailing trend is down and the price is consolidating below a key resistance level with a low ATR, we might anticipate a bearish breakdown. This is the power of using the ATR to identify phases of consolidation. It gives you a heads up that a big move might be coming, and it allows you to prepare accordingly. The longer the ATR remains at low values, the more powerful the following move is likely to be. So if you see an extended period of low ATR values, a prolonged phase of consolidation, be ready for a potentially large move. This is where the phase of expansion comes in. Once the market breaks out of its consolidation phase, it enters a phase of expansion. This is when the ATR starts to rise, indicating increasing volatility and larger price moves. If you've anticipated the direction correctly, you can now look to enter trades in the direction of the breakout, aiming to capture a chunk of this expansionary move. As I said, the average true range doesn't tell you which way the market is going. If the ATR is going up on the chart, it doesn't mean the trend is up. So instead of using the default ATR, you could use other indicators that incorporate ATR into their calculations. The first one is the chandelier exit. At its core, the chandelier exit is a volatility-based indicator that will help you determine where to place your stop-loss orders. It does this by using the ATR and a multiplier. This is a dynamic indicator, meaning it adjusts its levels based on the recent price action and volatility. As the price moves up, the chandelier exit moves up with it, always maintaining a set distance based on the ATR. If the price starts to fall and hits the chandelier level, it's a signal that the trend may be reversing, and it's time to exit the trade. The chandelier exit plots a single line on your chart, either above or below the price action, depending on whether you're looking at a long or short trade. When the price hits or crosses this line, it's a signal to exit your trade. The key is in the settings. You get to decide two inputs: the length of the ATR period, usually 14 or 22, and the ATR multiplier, usually between 2 and 4. A higher multiplier will place your chandelier further away from the price, giving your trade more room to breathe, but also potentially leading to larger losses if the trade goes against you. A lower multiplier will keep your stop-loss tighter, protecting your capital, but also potentially leading to more frequent stops. For day trading, you could start with an ATR period and a multiplier of 2. Then, you backtest. It's all about finding that sweet spot that aligns with your strategy and risk tolerance. The beauty of this indicator is its simplicity. It can be used with any trading strategy. Here's a basic setup for a long trade. You identify a market that's in a clear uptrend and looks poised to continue. You wait for a pullback or consolidation, and then look for a bullish entry signal, like a breakout or a bullish candlestick pattern. Once you're in the trade, you place your stop loss at the current chandelier exit level. As the price moves up, the chandelier exit will move up with it, effectively trailing your stop loss to lock in profits. If the price hits the chandelier level, you exit the trade. It's a simple but effective way to let your winners run, while also protecting your downside. And of course, like any indicator, the chandelier exit isn't perfect. False signals will happen, especially in choppy or sideways markets. That's why it's important to use it in conjunction with other forms of analysis, like price action and key levels. The ATR bands indicator is another volatility-based tool, which creates bands around the price action using the average true range. This indicator contains two bands that sit a certain distance away from the price action. This distance is determined by the ATR and a multiplier. Think of it like a river with two banks. The price action is the water, and the ATR bands are the river banks, containing and guiding the flow. The width of the ATR bands is dynamic. It changes based on the price volatility. When the price is more volatile, the ATR will be higher, and the bands will be wider. When the price is less volatile, the ATR will be lower, and the bands will be narrower. So based on how much the price has been moving, the indicator offers you a reasonable range for where the price might go next. It's all about watching the price action in relation to the bands. When the price is trading close to the upper band, it suggests that the market is in a strong uptrend. If it touches the upper band, this could be a signal to consider taking profits or to be cautious about new long positions. On the flip side, when the price is trading close to the lower band, it suggests that the market is in a strong downtrend. When price touches the lower band, this could be a signal to consider exiting short positions or to be on the lookout for a potential bounce. And of course, the ATR bands have their limitations. They're a lagging indicator, meaning they're based on past price action. So take the time to understand how the indicator works and experiment with different settings, like the ATR period and the multiplier. Supertrend is another ATR-based indicator that helps you determine the direction of the trend and potential buy or sell signals. When reading Supertrend indicator, it's all about watching for changes in color and position relative to the price. When the supertrend line is green and below the price, it's pointing north. signaling a buy or an uptrend. When it's red and above the price, it's pointing south, signaling a sell or a downtrend. I like it because it gives you a clear, visual representation of the trend by using a combination of the ATR and a multiplier. That multiplier is a way to adjust the sensitivity of the indicator. As long as the price remains above a green supertrend or below a red supertrend, the trend is considered intact. This can help you ride trends for longer, potentially increasing your profits. If you make a habit of consulting the ATR before every trade, you'll be a step ahead of the game. So take the time to understand how the indicator works, how to read its signals, and try to incorporate it into your trading plan. And if you need some strategies that work perfectly with the ATR, you definitely must check out these videos.